In this week's update, time for some contrarian thinking. US market getting top heavy and concentrated, but some sections are producing life-changing returns. My name's Garry Davis, as always, general advice only, and please remember to like and subscribe to the video. Let's start with our usual market perspective. I'm just seeing signs that it is warranted to just move a little bit more conservatively, and I'll explain that as we go through the video. I think it's fair to say at the moment, the way things are going, particularly in Australia, and they're not going all that brilliantly well. And there's a bit of a mixed picture in America, but it's a lot more positive than it is here. But I think it's reasonable for your base assumption to be that economic conditions are going to be a bit harder in the next 6 months and quite possibly longer. Now, it may not come to that, but I think that's a pretty reasonable base assumption based on probabilities at the moment. And there's probably no better time to start thinking more conservatively and a little bit contrarian, because generally investors are feeling pretty comfortable with the way things are at, and often that is near some sort of top, even if it's a fairly mild short-term top. But having said that, there are plenty of stocks that absolutely deserve the incredible trends that they're experiencing. They're high growth. Some are expensive, but some are also very cheap and on very cheap PEG ratios. So that's the ratio between the price earnings and the actual growth of earnings itself. And there are also some misunderstood stocks, and stocks like Nvidia, which I'll get to in the next slide, I think, is an example of a stock where it's very easy to look at the chart and think it must be overvalued, or to look at the PE ratio in the high 30s or low 40s and say, oh, that's too expensive. But when you understand the growth rate, it's actually not. It's quite extraordinary, but we'll get to that in a minute. So what is the process to better manage risk? Because that's what an investor's primary task is. It's not to throw all your eggs at the latest speculative opportunity. If you manage risk well and you own quality assets, then you'll be successful as an investor. But in my experience over 3.5 decades, very, very few investors think at all about risk. They're only thinking about where they can make some money and not really about managing risk. So the way to better manage risk is very simple, and I'm going to talk about this most weeks, and it's essentially the function of this Sunday video is to provide a perspective to just remind investors of what it is that works, and more particularly what it is that doesn't. So from my perspective, if your portfolio is going to have 15, 20, 30 stocks in it, then it's not that difficult to find only companies that can function well in a tougher environment. Why would you want to own a company that you don't know how it's going to perform when the economic conditions get more difficult? I mean, I don't understand that. And of course, as far as broad-based diversification goes, it's just a complete waste of time. So within the context of your portfolio plan, and everyone should have one, but I know that most people don't, use trailing stops to take some profit at this point in time. Because doing it that way, as long as you set the trailing stop at a sensible place that indicates that the character of that trend is changing, then you're letting the market action take you out. You're not doing it on the basis of an emotional gut feel, because that trend could just continue on and on with very small steps back, forming higher highs and higher lows, and you may as well stay in the trend. The point to get out is when you stop forming higher highs and higher lows. And so that's the obvious place to set a trailing stop to take profit. All right, so to summarize, it's about stock selection, obviously, and I only focus on just a sliver of the market, a small sliver of the market. There's probably only 50 or 100 stocks in Australia that are on my radar. I just forget about the rest. Then they don't even get a single thought. Next is the entry methodology, and you've got to be very clear about the methodology upon which you are buying these investments. And then thirdly, just managing the exposure, managing the individual weightings according to your particular requirements. And this is just what we do day in, day out in the Insiders Club and also to a degree in Portfolio Analyst. So if this all sounds familiar, if it, oh, here he goes again, it's just another way to restate what I've been saying for more than a decade. And the reason that I keep doing that is because it's very easy for your thinking to get diluted by all the rubbish that's out there in the media and all the misconceptions and all the old wives' tales. It's very simple. Just find the best assets you can. You buy them well. And if you do that, then as an investor over the medium to long term, you're probably going to do pretty well regardless of the economic conditions. It's really not going to matter that much. But judging by the questions, and I get a lot within the service and from outside the service, most people just lose sight of the very simple basics of good, solid investing. And that's essentially why I do this Sunday video, is just to keep tapping everyone on the shoulder and reminding you of what it is that works and what it is that doesn't. And as far as the traditional diversification goes, it's just for people who don't know how to manage risk and reward. I think it's that basic. Artificial intelligence. We're probably not going to see a better opportunity in our lifetime. There is nothing that would appear to be more certain. Not that anything in life is absolutely certain, but AI looks to be pretty much it in terms of investing opportunities. It's just so staggeringly exciting. And if you look at NVIDIA, and I was just blown away when I saw this number a couple of days ago, NVIDIA is set to, if the forecasts play out, and there's absolutely no reason why they won't, because they just keep smashing analysts' expectations, then NVIDIA will increase their net profit by 15-fold over the 2 years from FY23 to FY25. Now just think about that for a minute. We're talking about a company that's already, you go back a year or so, it was 1 trillion, 1.5 trillion. It's now 3 trillion. We're not talking about some small cap stock that has increased its net profit by 15-fold. This is one of the top 3, I think it's the top 3 now, biggest stocks in the world. And we're talking about increasing net profit by 15-fold over a 2-year period. I mean, that is just, it's mind-blowing, but it's real. And these incredible impacts will broaden dramatically. And we'll see some other stocks in quite a different array of industries will start to do things, maybe not quite as extreme as NVIDIA, but they will start to do things that are going to produce life-changing returns. However, there will be many, many pretenders. The bulk will be pretenders. They will get grossly overhyped for whatever reason. They will have relatively poor business models that are they're just going to spin their wheels. They're not going to be insulated from strong competition. And these sort of growth and return rates draw everybody in. So there's going to be a lot of competition. So you only want to be in the best of the best. So care is still needed. Artificial intelligence is not going to be a walk-up start just by anything, like people were doing in 1998, 99, 2000. If it had the word internet in it, you bought it and you made money, and then you lost it all and some. It's not going to be a walk-up start. Anything with AI in it is not going to be an instant success. In fact, I would venture to say that the majority are probably not going to be a great success. So you're looking for the best of the best. But make no mistake, this is real. Artificial intelligence is real. The growth in semiconductors and data centers is real. It is not going away, because unlike the lead up into the year 2000, when we had the tech crash, where the Nasdaq went down, I think it was about 83%. These revenue growths are real. The profit is real, and free cash flow growth is absolutely phenomenal. If you look at the free cash flow that NVIDIA is spinning off, it just blows your mind. It's incredible. And it is filtering down, and it's going to continue to filter down for the rest of this decade into the coming generations of beneficiaries. So at the moment, it's at the pointy end. It's at the data centers, it's at the hyperscalers, it's a very, very small number of stocks, but it's broadening very, very rapidly into many, many other areas that you wouldn't automatically think of. So terribly, terribly exciting, but you still need to do it properly. Now, if we look at American stocks, the S&P ended up 1.3% across the week. It was pretty volatile. The NASDAQ was up 2.4%. Interestingly, when we get to the charts in a sec, the year-to-date gain for the S&P 500 is 12%. But if we look at the equal weight S&P 500, which is the ETF code RSP, it's only up 4%. And therein lies the story that a lot of the performance of the S&P and the NASDAQ is due to the big tech companies. But if you look at the broader part of the market, it's stock participating, as we'll see in the charts. Now, that it could just be a pause, but it could also be a short to medium term top as well. So you don't want to dismiss it as it's not going to happen. But neither am I ringing alarm bells either, because I don't really see the environment where that's likely to happen. But certainly I'm seeing plenty of stocks that I follow in America, and I follow many, where we're seeing some pretty sharp profit taking. So yeah, it's just a bit of a warning flag. Now the US dollar index was higher, particularly on Friday night after the non-farm payrolls report, back up to 105. But the 10-year yield is easing down to 4.43, so that's not really creating too much pressure at the moment. And the VIX was also lower to the low 12s. Let's go and look at some charts. And we'll start with the S&P on a weekly, so set another new weekly high and a new all-time high, of course, by definition. And just look at how far, I want you to look at a couple of things. This is the peak in January of 2022 before we went into quite a significant slide. Just look at how far above that we are. That peak was at 4,800. We're now at 5,350. Look at where it is in relation to the 20-day moving average, the 20-week moving average. Look at the steepness of the 20-week moving average. So just try and remember those three things. And then let's look at the equal weight. So this is the equal weight S&P 500. We're basically at the same level as we were at the peak in 2022. So equal weight is underperforming. It's been underperforming throughout, but particularly at the moment. Look at where it is in relation to the 20-week moving average, and it's still looking okay, and it's still rising fairly nicely. But again, if you come back to the S&P, it's meaningfully above that 20-week moving average. So there's no question that RSP is weaker than the S&P, the market cap weighted S&P. So that's telling you that this market is being propelled disproportionately by the very, very large stocks. And that's not particularly healthy. And if we look at the Russell 2000, so this is now getting down into the small and mid-cap stocks, you can see we're nowhere near where we were. This is West January. Here we are. There's January 2022. We're actually trading lower than where we were at the peak of the market at the start of 2022. So these are all things just to be a little bit careful and conservative about. Now, if we look at the NASDAQ also, in fact, is even a bit stronger than the S&P. Now, drilling down to the next level, this is SMH, but of course, NVIDIA comes into this semiconductor ETF, and so therefore you would obviously expect this to be strong, and it is, but again, the disproportionate effect of NVIDIA. But look, I have to say that the other semiconductor stocks like Broadcom and Oracle and stocks of that nature are still doing pretty well, particularly Broadcom, and I think they're reporting in this week coming. And this is the semiconductor versus the S&P 500. If you look at a relative comparison over the last month, XLK is still doing well. So really no change here at all. And energy, of course, as crude oil has slipped, is at the bottom of the pack, and quite considerably so. And it's similar in Australia. The energy sector is the worst performing sector of the major indices in Australia. Finance has had a really big resurgence in the last week or so, thanks in good part to Commonwealth Bank, and I'll give you a perspective on that I think may surprise a few people, followed by healthcare, and then the IT sector. Just a couple of other spreads I want to look at that I think are important. This is a Russell 1000 growth versus 1000 value. So this is getting away from the impact of those big tech stocks. We're still seeing a healthy appetite for growth. There is more money flowing into growth than there is into so-called value stocks. So that's a real positive for the overall market. So that's why I'm not getting too negative at this stage. I'm just getting a bit more conservative. And the final one is consumer discretionary versus consumer staples. We saw at the peak in November, December of 2021 that this turned out to be an early indicator. It rolled over well and truly before the rest of the markets did in early January. So you had about 6 weeks of pre-warning that the market character was changing, and we ended up in a very, very significant ratio slide between those two sectors. If you look at the moment, it's pretty much in balance, and it has been in balance since the middle of 2023. So basically, it's been in balance for a year in terms of where the money flows are going into discretionary or staples. So they're all the key things that I wanted to take a look at. Aussie Stocks, our dollar was at 65.17. Our index rose 2.1% across the week. Banking led the way, but let's unpack CBA a little bit, because it is trading at a historically high multiple. Now, if we look out over the last decade and a half, went back to about 2010, then the typical PE range for Commonwealth Bank has been, or CBA, has been between a low PE of around 12 to a high PE of around 18. That's been the typical range. So when banks are in favour, they're trading 16, 17, 18. When they're not particularly in favour, they've been down around the 10, 11, 12 mark. So that's been history. Now, right at the moment, CBA is now trading on a current PE of 22 times. But more than that, so this is the absolute highest that my database says that Commonwealth Bank has ever traded. At the same time, that the forward earnings forecasts for FY24 and FY25 are actually negative growth over the next 2 years. So you kind of scratch your head and say, does that make any sense? And the answer is absolutely not, unless the forward forecasts are incorrect. And I find that hard to believe, because there are so many analysts that are all over the big four banks that they're not going to be too far off the mark. So we're paying significantly higher than the top end of the normal range at a time when earnings are going negative. That's just crazy. So at the very best, the next 5-year return for Commonwealth Bank has to be substandard. I'm not saying it'll be negative, but it has to be substandard. You can't invest in stocks where their growth is slowing or going negative at historically high multiple and still expect the return that you've got over the last 5 or 10 years. It's just not going to happen. So if you're sitting back really comfortable because you've always been in banks, then that's fine. You don't have to get out, but just understand what your return is going to be over the next 5 years and don't have high expectations. Now, also last week, iron ore, just going back to CBA, there are plenty of other examples. of this sort of thing. So you've just got to wake up to the fact that doing the same old that's worked for the last 3-4 decades is just not going to cut it if you want a decent return. If you don't care about the return, you're just there for the dividends, okay, fine, don't worry about it. But most people I talk to want to get a better return than what they've been getting. So, that's just the perspective that you need to understand. Now, iron ore last week was down. This is a bit of a head scratcher. Iron ore was down, but materials were pretty resilient. The Fortescue and Rio and BHP were pretty resilient in the face of how much the iron ore price has come down. So the message here for the Australian market is that it's absolutely vital that you understand what will produce a good return and what won't, because there are many, many parts of the Australian market that will not produce a good return in the next 5 years. It's that clear cut in my mind. Right, let's just take a quick look at the ASX 200. And it is important understanding what the big end of town is doing, the Commonwealth Banks and the BHPs and the CSLs, etc., because what the index is doing sets the sentiment, sets the tone for the rest of the market. And if the tone is negative, it just puts a bit of a drag on the other stocks that would otherwise be going up at a faster rate. Whereas if the tone is positive, then it helps. So, it's not irrelevant to consider what the indices are doing. So there's the ASX 200 on a weekly chart. It's within a whisker of its all-time closing high, which was at 7,900 at the end of March. We closed at 78.60, so we were within 40 points of the all-time high. If we look at the US dollar index, you can see a huge jump on Friday night with those non-farm payrolls that again just raised the question about whether the Fed will be able to cut rates or not in 2024. And the Australian dollar, of course, gapped down and went the other way. Turning now to precious metals. A lot of action in gold, very volatile. It ended up down $34 for the week to $22.93, but the weekly range was actually just a tick over $100. So we went up early in the week and then the gold price got smashed, really got smashed. And part of it was not due to the change in the US dollar. That change in the US dollar, as you saw, the big change, only occurred on Friday night. So gold was off sharply despite some factors that you would have thought were supportive. So it's, again, bit hard to fathom it in the short term. Now, silver was also down at 29.16, so it lost 3% for the week. So we got the similar sort of treatment. And it was really a multiple negative influence week for gold, because the US interest rate question was particularly in focus on Friday night. So US interest rates, as far as the market is seeing it, likely to stay higher for longer. That, of course, helps support the US dollar, and a higher US dollar is not good for gold, obviously, because of the currency effect. And also, China was absent for the first time in central bank buying of gold bullion in 18 months. Every other month, there'd been a buyer. So that sort of explains why the gold price didn't keep rising. It doesn't necessarily explain why it came back so sharply over a couple of days in the middle of the week. Now, if we stand back and look, so that's the very short term, and gold is volatile. But if we step back and look at the bigger picture, central bank buying is almost certain to continue. So, that one you can probably give a tick to as being a good long-term tailwind for gold. But the question around rates is much harder to feel confident about, because higher rates are going to be negative for gold, whereas lower rates are going to be very positive for gold. And I don't have a strong feeling really about it, because on a data point by data point basis, we're seeing so much up and down. So that's the bigger picture. We've got these competing factors of central bank buying, positive, rates could be positive, could be negative. Very difficult to know. Now, we've also got the Bank of Canada and the ECB have actually cut rates. I would have thought that that would have been a net positive for gold, and yet in the middle of the week, gold came off quite sharply, as we'll see in a minute. So we've already got some central banks that are starting to cut rates. So it's a very murky picture at the moment about what central banks are thinking. But look, the net result was very heavy losses in gold stocks on Friday in America. We were looking at falls of 8 and 10% for some of the world's biggest gold miners. So it was very significant. When the Australian market reopens on Tuesday, we are likely to see some hefty selling in gold stocks. Almost certainly will gap down. And we've got another session in the US on Monday night first before that happens. But all the factors at play, particularly if you select well, this rough patch should be pretty temporary, and it may be very brief. So let's jump in and take a look at what's been happening on the gold charts. So if we'll start with silver. So this is the silver chart on a weekly basis. If we go back to the week ending, the 17th of May, silver broke out, was looking fantastic. The following week, it traded even higher, got up to 32.5. But then, since then, it's been a bit negative, and we've actually broken that key breakout level. So that was a move not to be ignored. I don't know how far down this is going to go, but it's certainly a move not to be ignored. But at this point in time, we're still forming higher highs and higher lows at this point in time. So that is silver. Silver versus gold. Silver did get the worst of it last week, so underperformed versus gold. This is the gold in US dollars. So you can see we were down $34 net, but from the peak, and if I put that on a daily, you'll see the fluctuations. So we were up on Monday, down on Tuesday, up Wednesday and Thursday in the gold price, and then it really torpedoed on the Friday. And in Australian dollars, got cushioned a bit because our dollar came down. So the Australian dollar gold price didn't move all that dramatically. Now, if we look at GDXJ, you can see some fairly heavy selling on Friday. If we look at the relative comparison between GDX, the Australian listed GDX, and the Australian dollar gold price, we're still getting outperformance from gold over stocks, but that might change significantly when we resume trading in our market. And it's the Australian version of GDX. So ignore that. That will look quite negative when our market resumes. Now, just looking at the demand around China. So we know that there has been strong central bank buying, and that's pretty logical. And we're also seeing some pretty concerted central bank buying from some other European countries as well. So it's not just Asia. But if we look at what's happening more at the retail level, then customs data in China showed a 34% rise in the first quarter of this year compared to the first quarter of calendar year 23. So that's pretty significant. And the other thing that really does validate that the demand is real is that gold bullion is trading in Shanghai at a premium of around $48. So that means that supply and demand are not really in balance. Furthermore, another data point, young investors, Gen Z and millennials, are buying something called gold beans, which are very small gold, they're not bars, they're beans, but very small amounts of gold. And that is also showing that we're seeing broadening demand, from a demographic that might be more far more orientated towards cryptocurrency, but they're also buying into getting exposure to the gold market as well. So these are all things that are sort of validating this retail demand. And in China at the moment, the stock market is down. We've got real estate in severe trouble, and the shadow banking system has been under pressure for some time. So it's sort of logical in a way that we're seeing more interest into the precious metals market at the retail level. So that's gold. Copper was down to 4.45, and nickel also slipped as well. Partly US dollar related, but not totally. And West Texas Intermediate crude was down to the mid-70s. There's a spot copper chart. Sorry, I'll just go back to that. Here's the spot copper chart. So you can see we got to £5.10 pound, and now we're down to $4.45. It's been quite a sharp move, which in the very short term doesn't really tie into the long term. But anyway, it's quite probably just the dynamics of the futures market. We've got some profit taking, and the US dollar has done the rest of it. And there's nickel fluctuating in a very similar way. So wrapping it up, really important, particularly in Australia, don't lose sight of all the companies that are under stress across many different sectors, probably none more than the building industry. So they're stressed and they're failing, and the record of insolvencies is rising quickly. So the corporate situation in Australia is already not good at a time when we're just about to get legislations that are going to push up costs and lower productivity. So it's not going to get any better for a huge part of Australian corporate environment. Just a reminder from something that I said last week. I said it was easy to lose money in artificial intelligence and also in many other areas because we've got so many companies that are overvalued and they're poorly managed. So you really just need to be very, very careful about what you're doing in Australia at this point in time. But look, it's still an incredible opportunity to produce life-changing returns in the market. You just need to get organised so that you don't miss out. And it's not that hard, particularly if you've got someone to guide you. But if you just want to keep doing it the way you've always done it, then you'll probably get the same result. Portfolio Analyst last week was an edition of Taking Stock, which is very much a learning educational forum that I do once a month. It was about achieving strong returns with less volatility. There are things that you can do if you're a bit volatility adverse. You don't have to get out of the market. There are ways of reorganizing your portfolio to still get pretty good long-term returns, but with lower volatility. We looked at the highest quality long-term wealth compounders. We looked at the way that you can manage underperformers. So great stocks with a great outlook, but they're just not rising at the moment. They're going sideways or maybe even a little bit down. So there's a really important perspective about how to manage those sort of stocks. And one of the more important things is to always be mindful of your style, because different investors will have dramatically different styles, and it's really important to be mindful of who you are as an investor and have a plan that fits. But again, this is a message that I send just about every week. I hope it gets through because it's so important, and it does explain why most investors don't ever get the returns that they want. That's it for this week. There's more information on the website. There's my email address for anyone that wants to communicate with me, and I'll be back next Sunday. Cheers.